There's a game-changing investment strategy that my next guest says most investors know nothing about. It's called a 351 conversion, and it can save you serious money. Joining me now, Cambria Investment Management CIO and co-founder Meb Faber. Meb, great to see you again. Look, before we talk markets, you're in Los Angeles. Are you and your family totally safe from the fires?
We're good. We definitely have had some friends impacted. Pretty crazy time, but we are safe but smoky.
All right, well, that's good to hear. So we got a lot to get through today. I want to start with markets, then we'll talk about how you're helping investors save on taxes. So look, stocks have been on a roll for 3 years. I guess you could say for 15 years, really, and they're now pretty expensive. The headlines are all focused on how Trump's policies might affect the market. But what are you looking at?
Look, stocks have been romping and stomping. It's been one of the best periods in history. Now, does everyone feel fat and happy? I don't know, but it's a romping, stomping bull. We've been on 15% per year since the bottom in 2009. That is a 10-bagger. You've made 10 times your money, which is awesome. But as we know in markets, this is highly technical, but the good times lead often to the bad times and vice versa, right? The seeds of this next bear market have already probably been planted. It's a bit of a yellow flashing light. You mentioned valuations are sort of near peak valuations, not like they were in 2009. So on average, we tell people, look, this bull has had most of its run. Doesn't mean it can't go higher, but value stocks look much better. Foreign stocks have underperformed. Emerging markets have underperformed. Value companies there, we think, that are high quality, look much better than buying the very big market cap weighted expensive stocks in the U.S.
You've even said that maybe people should start looking at China. I mean, that market's been going nowhere for a long time. Maybe that's why.
Here's the funny thing. If you're a U.S. stock investor and you just John Bogle, Vanguard, index your global portfolio, that means you now put 2/3, almost 70% in U.S. stocks. And that's the starting point. That is 10 times more than any other country in the world. So most people don't have foreign exposure, particularly in the U.S. They certainly don't have emerging markets. So even if you do allocate to China, which is cheap, right? We like to look at markets when you can say they've gone nowhere for 30 years. I like the sounds of that. There's no question that China is cheap in much of the rest of the world, certainly relative to the U.S. So I think it deserves a place. Doesn't have to mean you have to go all in on China, foreign and emerging, but certainly a great diversifier to the U.S.
Real quick, before we get to taxes, your bond portfolio, what are you doing there?
Oh, man, this is one of my most non-consensus views, all right? So I think a lot of people out there say, you know what, U.S. stocks are expensive, look elsewhere. But in the fixed income land, the same is true, right? Where you have T-bills at 4.25%, the risk-free rate, but the rest of the bond market doesn't yield much more. Now, the historical relationship between riskier bonds like corporate bonds and junk bonds and things like the 30-year U.S. bond, despite the fact that they're down a ton, I think the 30-year bond is down 40%. Think about if stocks were down 40%, people would be losing their mind. They just don't have enough margin of safety. And people say things like, wow, corporate spreads are some of the lowest in history, junk bond spreads, lowest in history, but then they keep buying them. So to me, a lot of these bond markets should already be yielding 6, 7, 8, 9, 10%, and most of them are down around 5%. So there's potentially a lot more pain in the risky bonds. We're chilling out in T-bills. Our fund TYLD does this, where it just kind of sits in T-bills and chills until you get paid to own the riskier ones.
All right, let's talk taxes. You're launching these new ETFs that allow investors to diversify out of stock positions without paying taxes on the gains. And that's a big deal for many investors. They got big gains in stocks. They should probably diversify out of them, but they don't want to take the tax hit. How does this work?
How many times have you heard somebody say, look, I own this stock. It could be IBM, Walmart, Apple, McDonald's, more recently, NVIDIA. And they say, but I can't sell it because the tax man will kill me. Well, real estate investors have had a solution for this forever. It's called the 1031 exchange, right? You sell one building, you diversify into another one. That's a tax-free transaction. You're not washing the gain. You're just delaying paying taxes. Well, it turns out there's a part of the U.S. tax code called the 351 that's been around for almost 100 years. And so now the modern ETF allows you to seed one of our funds. So you say, hey, Meb, I got a highly appreciated portfolio. I don't want it anymore. I would like to have some other things. You reach out to us. You seed the ETF launch, and there's some rules around it. The top position can't be above 25%. So you can't just give me all NVIDIA. You get an ETF in return. And as we all know, ETFs tend to be low cost. They tend to be much more tax efficient than things like mutual funds. in hedge funds. So you end up with a better vehicle that's diversified. And for many investors, that's a much safer place to be than having most of your net worth in a single stock.
All right, we've got to leave it there. People can look that up on the internet, and there is an ETF ticker TAX, T-A-X is your first one, but I know you're rolling out more of them over time. Meb Faber, thanks so much for coming on the show.
Great to be here.